the Investor Coaching Show. Here's your host, Paul Winkler.
All right, I'm back here on the Investor Coaching Show. Paul Winkler talking about money and investing. And one thing I'll talk about, there's a couple of interesting things that I want to get to before this hour is out. Number one, I'm going to talk a little bit about, there was something about taking an income from a portfolio, and it was talking about transitioning to taking an income out of a portfolio and ways to do that. And I just had to completely disagree with something that they actually said regarding that. So I'm going to get into that. The other thing that, there was one thing, and I'm going to get to this gold thing in just a second, but there was this other thing that I saw that was interesting. It was Americans in their 30s are piling on debt. And I noticed that, if you look at some of the younger generation, they're not necessarily, it's interesting to me because a lot of them have gone to school, and many of the schools are starting to teach about debt now. They're starting to teach about basic finances that I've been seeing. And I don't know if this is across the board, but I just noted it locally quite a bit, that there were a lot of the schools were actually teaching about making sure you understood how to work a bank account, credit cards, the problem with credit cards, and the problem with spending too much money, not having enough income or enough money left at the end of the month, to make it through. And a lot of people understand the idea. If you have, let's say, somewhere in the neighborhood of about 12% interest, and a lot of these credit cards are way, way higher than that. But if you have 12% interest, you're spending money twice in 6 years. Literally, debt doubles every 6 years. The rule is 72. 72 divided by your interest rate tells you how long it takes for money to double. And if it's debt we're talking about, it doubles about every 6 years. Well, it's way faster if you think about it, if it's at 20%. But apparently, there are a lot of millennials have racked up a historic amount of debt because of since the pandemic started. And they found that there's like a 27% jump from late 2019. It's the steepest increase of any age group. And you go, why? What is it that's going on? And they said it's a worrying sign for those coming up behind them. And I don't know if I agree with that, just because
not me, Paul.
No, not you. Now you've been.
I still have student loans, but not me.
Well, the people around here, they listen to the show, and
yes,
that's not going to happen. But you do. You find that they're saying the younger generation that they're going to follow in the footsteps, and I find a lot of times the younger generation goes directly the opposite of the generation before them because they see the mistakes that they make and they learn from them. So
it's the gap.
It is that
generation
gap. It is a gap.
You know that, right?
And in many ways, I've seen it over time where previous generations do the exact opposite of the other one. So we'll see. So this thing, I want to talk a little bit about. Last week, I got into discussing, we were talking about currencies. And we were talking about digital currencies. And I just made a really quick comment after talking about digital currencies and, countries actually exploring the idea of going to a digital currency, what the pros are, what the cons are, and why it is such a big, it's such a big issue with a lot of the Federal Reserve type organizations around the world. Is because you got privacy issues. Some people say the privacy issues would actually be privacy would be increased as a result of it. You'd be bypassing the banking system. That gets a lot of people a little bit up in arms over that. How would you deal with that? So there are all kinds of issues. And then I just made a quick comment about gold. And I said, hey, look, here's something to consider. A lot of people hear these types of arguments, and what they do is fearfully go toward investment vehicles that they think are going to protect them from such a change. So Leviticus, if you would play that segment from last week, and then I'm just going to go through there was a voicemail somebody left. I'm not going to play the voicemail, but I'll just tell you what the voicemail said. I mean, people are talking about gold, for example. Oh, that's why I'm going to buy gold. Have you been noticing what gold has been doing for 30, 40 years? A whole lot of nothing. I remember back in 1980, they were saying it was going to go to 2,000 an ounce, and we're still waiting. It's still under that. And, you had this little jump in December, I think it was, in gold prices. Then it came right back down again. It's been coming right back down again. With all of these fears and all this terrible stuff that's supposed to happen, why isn't it going up like crazy? I'll tell you why, because it's not a panacea to our concerns about what's going on around the world. So, a lot of the concern that people have is that maybe that the government's spending too much. There's a devaluation of the dollar. Let me tell you, there has always been a devaluation of the dollar. Inflation is something that we have always had since literally the 1930s. And the reason being is that a little bit of inflation tends to be decent for the economy, because if prices are a little bit higher next year, people will buy things now rather than wait. If they buy things now rather than wait, then you have purchases taking place. Companies make money now. Governments make tax money right now. So a little bit of inflation is something we typically have. What we worry about is deflation if prices go down, because then people wait, and they go, well, it's going to be cheaper next year. So I'm going to wait and I'll buy the thing next year instead of buying it this year. And that is why deflation is something that is always more of a concern for Federal Reserve banks than inflation is. Now, number one, the person that called the voicemail says, yeah, I heard Paul say that gold hasn't done anything in 40 years on 99.7 Saturday afternoon. It's pretty public knowledge that gold has went up. He said SIC. That's exactly what he said. Went up 325% over the past 40 years. So he was a little off on the calculation. I don't know what he's trying to do with that. I'm sure he knows it went up 325%, but obviously he's lying to everybody on the radio about it. I just want to point that out. Might want to check his figures out. And what I said was it's done not a whole lot of anything. I guess it was something like that. It hasn't done a whole lot of anything over that period of time. And, if you look up what hasn't done a whole lot of anything, what that actually means, it's not anything significant is the point that I was making. I didn't say it didn't go up at all. That wasn't the point. And because actually it was 307% to be exact. And he said 325. 307% is the exact amount from 1983 through 2022. But if you look at the return after inflation, which is all that matters from an investing standpoint, it's 0.84% is the rate of return after inflation. Now, if you look at the period of time, and I made the comment about from 1980, they said it was going to go to 2000 and now it was actually a negative rate of return over that period of time. From 1980, it was actually a negative rate of return after inflation. But here's the thing. I said it was a whole lot of nothing because if you look at a 307% return of gold, you may say, hey, wow, 307% return, that's really great. But over the same period of time, large U.S. stocks went up 7,000%. Now, I would say that would be something right there, 7,000%. Small companies, about 5,000%. If you look at large value stocks, which is another area, a market that I talk about, that's 9,000% versus 300. If you look at small value stocks, which is what I typically talk about overweighting a bit in a portfolio because small value has a higher expected return and it has the tendency to reduce the risk of the portfolio, 17,000% return over that same period of time versus 300. So I would stand by my comment that it's a whole lot of nothing comparatively, is my point right there. Now, why? If you look at gold, it's just a commodity. And, the thing that happens is it goes up and down in value based on supply and demand. And a lot of people believe that because it has been a currency or was supposedly used as something, you have to go way, way back. It's never been a very practical currency. And the reason being is that walking around with a bar of gold is kind of a pain in the neck. And to go and buy and sell goods and services with a bar of gold is a pain. It doesn't work really well. So what happens is we've had where we, in the past, had gold in storage in vaults, and then they issued gold-backed dollars is where it really started. And the problem that you ran into, and the reason we went off the gold standard, is because if gold prices, let's say that the economy, people felt bulletproof. They felt really good about the economy and they thought, hey, things are growing really, really great. They're really optimistic and everything's wonderful. Then what would happen is people would go and turn in their gold for dollars because they wanted to jump in and get in on the activity in the economy and go and buy things. And you couldn't go and buy things with gold bars. You went and bought things with the dollars that were actually you could trade them in for gold. And then what happened is you did that, and all of a sudden the economy heated up so much it went crazy. And then people would get, oh my goodness, they get nervous, and then go and turn in their dollars for gold. And then the economy would go through a horrible trough, and it would crash into a depression, and it would be awful. And this happened all the time, and you had runs on banks and things like that, and that's why we came off the gold standard. That was the reason that we did that. Now, what happens is people still think back to the times when they heard about these gold certificates and actually having an economy based on that. And what they do is they buy gold because they see these commercials saying, hey, you can make a lot of money. You can, it's going to protect yourself. Hey, the debt's going going crazy and all of that. Well, yes, it is true. And the dollar has been depreciating in value. And this is how people get away with this stuff. They give you enough truth in order to pull you in, is what happens. And I've seen people over the years, financial people, over the decades that I've been doing this, give just enough truth about a matter where you go, yeah, that makes sense. And then what you do is you make the mental leap that what they just said was true, then everything else that's going to come out of their mouth is true as well. And you'll hear a commercial for something like gold, and you go, hey, this person said gold, and yeah, it makes sense. The dollar's devaluing, and gold's up 300% over the last 40 years. Now, you don't even think about the fact that, hey, you know what? Stocks are up 7,000%, large stocks are up 7,000%, and small value stocks are up 17,000%. That doesn't cross your mind because you don't know that data, and they're not giving it on their TV commercial. So what happens is that you make the mental leap that everything else that comes out of their mouth is going to be truthful. And you can forget the fact that if you look at the GDP in 1980, the gross domestic product, the output of the U.S. economy, it was $2.8 trillion. $2.8 trillion in 1980. What is it now? $25 trillion. Well, you can even use that number to mislead because, there are more people now. So we should have a higher economy. Even if you adjust it for per capita data and bring it down per capita, per person, GDP per capita was 12,000, just over 12,000, 12,575 back then. And if you look at it now, it's 70,249 as of 2022. Well, there's a big difference between 12,000 and 70,000. So still in all, the per capita GDP is up. Why? A part of that you would look at is because of the fact that we have inflation. The dollar has gone down in value. Well, why does that matter? Because earnings of companies are in the GDP. And what do you own when you own stocks? You own the earnings of the companies. Hence, this is the reason the stock market has protected us from inflation. So if you look at this and go, oh, well, maybe it makes more sense to own companies than it does to own gold. And I made the comment last week, and if you own stocks, you own companies that are mining companies. And you also own their land, which has gone up in value. Tried to find data on that, but it was kind of hard to find really great data on it. But, the data that I did find did show that there was a pretty big increase per acre in cost over that period of time, but it was inconsistent, the data, so I didn't want to share it. But, how about the square footage, what it costs to build a square foot of property, of commercial property? For example, there's a big difference between what it cost back in 1980 versus now as well. And I own those buildings when I own stocks. I own their land. I own their equipment. And I own their output because I am the owner of the company and I own their earnings. So keeping in mind that, this stuff sounds great in commercials and it sells, I'm sure it does a really great job of selling gold for investors who are scared and just take the bait. But I would still stand by my point that it's a whole lot of nothing over 40 years and not something that I would do as an investor.